ESG, real or marketing?
It's a complete fraud.
Complete fraud.
It's so ridiculous. Governance has been addressed. That's useful. But, this idea that you're going to get a stamp that says, oh, listen, my supplier, I've offset their carbon credits and now I understand it's a joke. It's jargon.
ESG investing, or environmental, social, and governance investing, has grown from an obscure and unknown part of the financial markets into a $4 trillion market, attracting both admiration for its supposedly noble goals. The slogan of ESG investors is to do well by doing good, and ardent criticism. Palihapitiya's main argument was that moneymakers are labeling their products as ESG-friendly just to attract more or cheaper capital, without actually embracing the ethos behind ESG. This process is known as greenwashing, and many in the financial services industry have been shown to be guilty of it. Greenwashing is when a fund manager or an investment bank allures investors in, be them retail investors, everyday people who are looking to buy a fund for themselves, or institutional allocators, sophisticated institutions which allocate money on behalf of other people, with the promise that their product took into account environmental, social, and governance issues, but when in reality that is not the case at all. The UK's Financial Conduct Authority, the FCA, which is the regulatory body of the financial industry, recently wrote an open letter to CEOs in which it stated that it prepares for a crackdown on greenwashing among hedge funds. Hedge funds are notorious for their secrecy, and therefore some shenanigans should have been expected. But the lies of the ESG industry are not confined only to hedge funds. Traditional asset managers have also been accused of greenwashing. Recently, tech billionaire Elon Musk called ESG a scam in a tweet which sparked a strong debate over this type of investing. Musk criticized this in his tweet when he wrote that it had been weaponized by phony social justice warriors. Musk also pointed out that oil giant ExxonMobil, which has been mired in controversy over claims of climate denialism, was listed in the top 10 for ESG, while his electric car company was booted off the list entirely. The dodgy politics behind ESG investing also surfaced when Russia invaded Ukraine earlier this year. Asset managers from around the world and politicians did not know what companies were ESG compliant or not. In the absence of Russian gas, are coal power plants environmentally friendly again? Were defense companies, for a long time portrayed as evil institutions, once more beacons of hope for Europe? In many cases it seemed so, and BlackRock, one of the biggest champions of ESG investing, changed its tone completely. In recent years, BlackRock chief executive Larry Fink has urged companies to get behind a more enlightened vision of capitalism. Management teams, he's written, should embrace purpose, consider the interests of a wide range of stakeholders, and wake up to the growing risks of climate change. In the wake of the war in Eastern Europe, however, the world's biggest asset manager issued a statement with a rather different tone, as it warned it would vote against the majority of upcoming climate-related resolutions in an unusually lively voting season. The document, issued by BlackRock's investment stewardship team, complained that a large number of these proposals were unduly prescriptive and constraining on management, and said it would oppose any measures intended to micromanage companies or that would not promote shareholder value. It seems that ESG was put aside when politics became inconvenient to support it, leaving only the question of money to be considered. Big politics and potential fraud aside, if we can put them aside, more recently ESG investing has raised suspicions even among its supporters. Institutional investors like BlackRock and Schroders, who now worry that the virtue investing product market has entered a dangerous bubble. The Bank of International Settlements, the central bank of all central banks, in a 2021 study agreed with this conclusion. ESG investing is a dangerous bubble. One of the most well-known voices in finance, Professor Aswath Damodaran, agrees that ESG is the most oversold and overhyped concept in the history of business.
This is, I think, the most oversold, overhyped concept in the history of business. I've never seen a concept sold so much with so little going for it. So the problem with ESG is people talk the talk, but there's really nothing to back that. So I think when people talk about ESG being good for companies and good for investors, my reaction is show me. Show me where, show me that that it is in fact good for businesses and good for investors, because I don't see.
If ESG is a bubble, then it is part of a much bigger bugger, one that encompasses all sorts of assets, bonds, real estate, and equities. Legendary investor Jeremy Grantham, founder of GMO, a large asset manager, is mainly worried about U.S. stocks.
This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic.
It's a pattern.
It's a pattern. It's a very rare pattern. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration.
However, ESG, if it is a bubble, is not only confined to US stocks. ESG ratings are applied across the world, and European investors in particular have been very eager to buy these products. As such, whether ESG is a fraud or part of a mega bubble, when the trend reverses, there will be a lot of panic in the markets. But what exactly is ESG? How is it defined? Well, the answer depends on who you ask. The Financial Times defines it in a recent article as doing well by doing good. Blaine Townsend implied that ESG can be defined as do no harm. That is the central concept of traditional faith-based investing and, to some degree, the central concept of traditional socially responsible investing. Meanwhile, Harvard Law School views ESG as a set of factors used to measure the non-financial impacts of particular investments and companies. Similarly, McKinsey thinks of ESG as a set of concerns that translate into some criteria. Forbes stated that ESG is the new buzzword, and KMPG boldly claimed that this concept must be embedded in your strategy and form the overall narrative and purpose of your organization. Vague, unclear, not very defined for a notion that informs how billions and billions of capital are allocated and which continues to gain importance. Perhaps this wishy-washy way of defining an important investment criteria has led to the above criticism. What do you think? Do you believe that ESG is true to its ethos? Do you believe it is a sham or that it has reached bubble-like levels? Let us know your views in the comments below. For more content, subscribe and like this video. Thank you for watching.